Recessions make the rich richer and the poor poorer. Why? Rich people know how to take full advantage of the economy and its cycles, while the poor get swept up by a market they don't even see. You know how rarely we do stock videos, and what happened the last time we did one of these, so pay attention. By the end of this video, not only will you have a list of 15 stocks that we're investing in right now, but you'll also better understand how to move from being an observer of the markets to an active player. Welcome to Alux.com, the place where future billionaires come to get inspired. The best time to invest is when there's blood on the streets. That's a metaphor for the entire stock market looking red. We'll make sure to keep this video as beginner-friendly as possible, especially since this isn't financial advice. It's just keeping you guys up with how we're moving some of our money around in times like these. Number 1. Airbnb. Price right now, $119 per share. We love Airbnb. We're big fans of Brian Chesky and what they're doing over there. The company is down 44% in the last 6 months and is currently trading under $120 per share. We bought our first batch at $113 per share, but we'll consistently acquire more and more of all of the stocks mentioned in this video in the following weeks. This was a company that was supposed to get annihilated by COVID, and they still brought in $6 billion in revenue last year. Tech companies have been crushed lately, but the underlying business is valuable and good. We use Airbnb. We think their product is continuously getting better, and we see them as a massive competitor to the entire hotel industry. In terms of the next 12 months, we don't expect the stock to stay under $200 a share, giving investors at least a 50% return. This is a company that we love, with a product we use, with a vision for the future, and with over $2 billion in free operational cash flow. Number 2. Adobe. Price right now, $395 per share. Adobe is a lot bigger than that PDF reader you have on your computer. Photoshop, Illustrator, Premiere, After Effects, and many more are by far the most popular tools of the creator economy. This video is edited on Adobe software, as are most all videos. The majority of logos, banners, anything digital for that matter, all touch Adobe at some point. Same as with Airbnb, Adobe is down 42% in the last 6 months and is currently trading at under $400 a share. And even better than Airbnb, Adobe has been making money year over year since we became investors in 2017. This is a highly profitable company in a space that's growing faster than ever before, with products that are consistently getting better. 12 months from now, we're expecting at least a retracement back, which will provide investors with at least 40% returns. With the rise of Web3, digital will explode, and we're betting hard on companies that will play a part in the creation of this new market. Which brings us to the next company. Number 3. Nvidia. Price right now, $166 per share. Most people might not understand it, but the metaverse is coming. Actually, it's already here. All of it will run on graphics processing units, or GPUs. These are in every computer out there. It's what allows your computer to generate visuals. Nvidia is one of our superstars. Everything we see coming will rely on the kind of software they produce, and that includes gaming, VR, AR, and metaverse worlds. These niches are growing exponentially faster than anything else around, and GPUs are essential to all of them. The Goliath in this space is Nvidia, and there's no way they're not going to make bank in the next decade. Stock-wise, we follow the same market pattern. Share price is down 46% in the last 6 months, and it's currently trading around $166. This is a company that has an average 36% profit margin and is bringing in over $25 billion in revenue this year. In our opinion, there's no reason for the huge discount we're seeing on the share price right now, so we're taking advantage of it. Best case scenario, you're doubling your money in the next 12 months. Worst case scenario, the stock will be around $160, so not much to lose. We can't wait to see if we're right about this one, especially since the next company is leveraging Nvidia's tech. Number 4. Unity Software. Unity is one of our more aggressive plays. In every portfolio, you should have a few of these that have the potential to outpace everything. There are two massive players in the world of game engines: Unreal Engine, which is now owned by Tencent, the Chinese company, and Unity. Although Unreal has unlimited money available, Unity is the underdog that's been able to hold its own. Their software allows for ultra-realistic graphics. What you see on the screen right now isn't an actual human. We believe that in the next decade, we'll cross into what is called the uncanny valley, a point in technology where you won't be able to tell if what you're seeing is an actual human or if it's computer-generated. Unity is playing a big role in that. So let's talk financials. Unity is down a whopping 82% in the last 6 months, with the price trading above $30 a share. From our perspective, this is a perfect asymmetric risk situation that has the potential to provide incredible returns for investors in the next 12 months. The company had $320 million in sales in the first quarter, which is ballpark what they spent last year to acquire Parsec. These might be famous last words here, but Unity is probably gonna be fine. Number 5. Nike. Price point right now, $109 per share. Bet you didn't expect to see a shoe company on this list, but hey, if it makes sense, it makes money. We love Nike. We buy products from them. We enjoy their products, and they're part of the culture. You should own shares in the companies that make the products you love. Don't sell unless their products stop fulfilling your needs. As long as you remember this rule, you'll do fine in the investing world. Nike is iconic, but despite their size, brand power, and reputation, they got caught up in the market crosswinds with everyone else. They're down almost 40% in the last 6 months. For a company that's consistently growing sales year over year, a company that brought in almost $45 billion in revenue last year. When all this charade eventually fades, the stock will recover because any business that has this kind of brand loyalty will be able to pull through. 12 months from now, you should be looking at 50% plus returns on your investment in Nike. Number 6. UnderArmor. Price right now, $11 a share. If you watched our last video, you know why we like UnderArmor. We jumped in April 2020 at $8 per share and liquidated our position last October at $21 a share. We feel like now it'd be a great time to jump back in. In the last 6 months, UnderArmor stock is down 60%. They're a great company, and as with everything else on this list, we enjoy their products. We love the underdog position and how creative they have to be to keep up with the big boys like Nike and Adidas, and they're doing great. They're able to remain competitive by having a smaller profit margin at 6% compared to that of Nike, for example, that's at 12%. This is the kind of play you make when you want to penetrate the market and build up the brand. The $5.6 billion in revenue doesn't lie. In terms of 12-month projections, we expect the stock to return to somewhere in the $20 range, at which point we might consider partially liquidating our position. And Aluxer, if this is your first recession, we recommend the book Unshakable by Tony Robbins. You can go to Alux.com/freebook, and if it's your first time signing up, you'll get the audiobook for free thanks to our friends at Audible. Number 7. PayPal. Price right now, $76 per share. PayPal is one of those counterintuitive bets. It's too tech for old people to care about it, but too old tech for the Web3 kids to find it cool. PayPal is no longer a cool business, but it's still making a ton of money and growing in users. Most people don't realize that 22% of all online transactions in the US are handled through PayPal. And even with all of that, the company crashed 65% in the last 6 months. The all-time high was $300 per share only 10 months ago, and the same share is trading around $75 today. It's bonkers. This is a company that brought in $25 billion last year and is growing everywhere around the world, where more and more people get access to online marketplaces. Do you know Venmo? Do you use Venmo? Well, PayPal actually owns it as part of its payments ecosystem. With e-commerce on the rise, with online access quickly entering markets that we've never had it before, we think PayPal has a pretty good strong case to stay. Number 8. Square. Price right now, $78 per share. From one payment processor to the next. We love betting on multiple players in the same industry because if we feel like the industry is expanding, it doesn't matter if you pick the right horse. Square is the brainchild of one of our favorite entrepreneurs, Jack Dorsey, the founder of Twitter. In the past 6 months, Square is down almost 70%. We began investing in Square in the middle of 2020 at $85 a share, as their growth began. And because we are constantly restructuring our portfolios, we fully exited the position at the end of October last year at $265 per share, making it one of our best investments to date. And now that the stock is back under $80, well, we want to go on that ride again. The company is making bank. And with Elon taking over Twitter, Jack is more focused on Square. And honestly, we're expecting at least a 2x from where we are today in the next 12 months. Number 9. Spotify. Spotify is another one of those companies that we've had in our portfolio. We entered at $150, exited at $250, and forgot about it. When this tech crash came around, we checked our favorites, and lo and behold, Spotify was trading at under $100 a share. Last year, they took $1.5 billion in financing, and the company is looking a lot better on paper than the markets would make you believe. And yes, they're one of those companies that lose a little bit of money every year, but the number of paying users is growing year over year. Spotify has gone up against Apple and Google, and they still made a name for themselves. We think they're a viable candidate for 50% plus returns in the next 12 months. Number 10. Coinbase. Price right now, $66 per share. We're going there, because this might end up being the best trade in this entire list. Coinbase, the largest regulated crypto exchange in the United States, is trading at $66 per share, down from $350 back in November. The stock is down 80% in the last 6 months. Now, this is a super fast-growing business in an emerging sector that's making between 25 up to 50% margins, no matter if the price of crypto is up or down. Exchanges don't care about the price of the coins transacted on the platform, as they make their money on commissions on said transactions. The number of users is going up, revenue is going up, profits are going up, yet the stock is tanking. Their profit-to-earnings ratio is 5.6 for those of you who are into financial analysis. And that's insanely good. Apple, for example, has a PE of 23.1. By this point, you know we believe crypto is here to stay. We're accumulating there as well. This is an opportunity for those of you who want exposure to crypto, but don't want to get caught up in all the wallets, coins, and exchange environments. Once this crypto bear market is over, we're expecting Coinbase stock to trade above $200 a share. This actually might be one of those moments where stock investing could be less risky and more profitable than crypto. Number 11. Palantir. Price right now, $7 per share. We don't care how many times we have to say this. Peter Thiel is one of the greatest investors of all time, and Palantir is his baby. Palantir is down almost 70% in the last 6 months. The company creates software for nation-level organizations. The United States government is actually one of their biggest clients. The new world war is a technological one. Our belief is that China will overtake the US as the #1 superpower, but the US won't go down easy. Their only chance is through high-end tech, and Palantir will be there to play a big part of that. They're also the kind of company that can afford to lose money indefinitely as long as they provide value for the state. And although they lost $500 million last year, they have the assets to cover it and the contracts to keep the money coming in. Price-wise, we're expecting to see the stock move back above $10 a share. So if you're in before that, you should see a profit in the next 12 months. Number 12, Netflix. Price right now, $175 per share. Y'all just love to hate on Netflix, but we know you're binge-watching Selling Sunset. The recent dump of Netflix is extraordinary in our eyes. Yes, it was the first time in the company's history when it didn't grow the way they expected it to. Yes, they're trying too hard to make politically correct content and they don't have consistent bangers. But most of you watching have a Netflix subscription. Netflix stock dropped 75% in the last 6 months. But the thing is, Netflix is actually making more money every year. So fundamentally, the business is steadily growing, yet the stock price reacted in ludicrous mode. Although other players are carving out their own space in the streaming world, we have no reason to believe Netflix is supposed to be this undervalued. So it's just a matter of time until the markets correct upward. Number 13, Walt Disney. Price right now, $105 per share. Speaking of streaming services, Disney is killing it right now. After Endgame, everyone thought it was all over, but no, they're still releasing bangers. Disney Plus is expanding like crazy in every geography, and they're giving Amazon, Netflix, and HBO a run for their money. Watching the stock drop 35% in the last 6 months got us wanting for more. And this is a particularly interesting price point because Disney stock has returned to the price point it was at 5 years ago. So basically, you're getting 5 years of Disney company progress at the same price point it was back then. Disney brought in $67.4 billion last year, and as their digital business grows, more and more of it will be profit. Strong brand, great service, content that we love equals a recipe for success. Prediction-wise, it's kind of hard to tell with Disney, but we don't see the stock going down from here. 12 months from now, we expect above 50% returns for investors. Number 14, Starbucks. Price right now, $70 per share. We love branded companies, and there are few brands with more power than Starbucks. Stock price is down 35% in the last 6 months, from $115 to roughly $70. Business-wise, it's all looking good. The company recovered well post-COVID and even brought in almost $30 billion last year. And as we see the world getting back to normal, we think more and more people will engage with Starbucks. People don't want to go back to the office, but they do want to get out of the house. Starbucks has the culture of the entrepreneur, writer, designer working from their coffee shops, which fits really well into the current narrative. Plus, they make decent coffee. Depending on how bad inflation gets, we're treading carefully here. As rents and commodity prices rise, we still might see a second dip in the price. Number 15, UiPath. The last company on our list is in the automation business. They're creating bots to replace humans in multinational companies. The stock price is down 76% since their IPO, but from an operation perspective, things seem to finally have hit a stride. The company now has co-CEOs focused on separate growth divisions, and once everything clears, we should be seeing steady movement upward. With AI more and more aggressively taking over basic functionalities, we expect the entire industry to grow. We believe UiPath will return over 70% for investors at some point in the next 12 months. Ideally, we'd recommend you look through this list and pick 5 stocks in which you believe in as well. The only way to learn financial education is to have some skin in the game. Use any trading or investing platform you want. There's an abundance of them, and we've refused to be sponsored by them in order to keep this video honest. Everything you've learned today is our personal point of view, and we're putting our money where our mouth is. Some of you might want to play along. Make your investments, and let's circle back to this video a few months from now and see where your portfolio is at. Hopefully, we will all be substantially richer. Which makes us wonder, what % in yearly returns are you comfortable with? Is it 10%, 20%, 50%, or are you going YOLO trying to strike gold? Let us know in the comments. And as for the true Aluxers, of course, we have a secret bonus waiting at the end. We're in the early stages of a global recession. Yep, we're already in a recession. Economic growth will slow down in the second half of 2022. Inflation is at an all-time high, and everyone we know who's got money is getting ready. We might not bottom out next week. It might be early next year. But in the next 12 months, it is highly probable that we will have 3 or 4 big financial events that will shake up the markets. The poor will get poorer. The rich, well, they've been through this before. We've been through this before. Property prices have shot up due to inflation. Everything is 30% more expensive than it was 2 years ago, but wages haven't moved at all. The poor are still getting paid the same, and it's gotten to a point in which they're completely doomed if they keep playing the current financial game. If there's one thing to take away from this video and this golden nugget we've reserved only for you guys, it's that patience builds wealth. It's not how much you're willing to wait for your wealth to compound, although that is important, but how much you're willing to wait around in making a move. And when the time comes, make a move that's decisive. We've learned this from Charlie Munger, Warren Buffett's right-hand man. They're willing to wait 5 years, sitting on billions in cash, to find an opportunity to move on. And when they do, they go in for the kill. Most of you will enjoy this video. Maybe some of you might even favorite the stocks that we've mentioned. A few of you will spend a few $100s just to feel like you're joining in. Maybe get some vacation money. But there are a few of you sitting on that fence wondering whether or not to pull the trigger. Unfortunately for you, nobody will be able to pull the trigger on your behalf, not even us. So get yourself in position, look at the market, and find your window of opportunity. Move decisively in the next 6 months, for this move might have ripple effects for years to come. We hope every single one of you watching these videos until the very end will get rich so you never have to worry about money again. If you're here to grow your portfolio, write the word growth in the comments. Let's get it, Aluxers. Thank you for watching this video, Aluxer. If you found it valuable, consider subscribing to our channel and joining our awesome community. And if you're still hungry for more, we handpicked this video for you to watch next. Or head over to our website for more amazing content. See you tomorrow.